Before your company goes public, your secrets go on record. In an IPO, disclosures aren't optional. It is the price that the promoters pay. And with that in mind, the next session revolves around the legal and regulatory considerations for an IPO. And who better to help us know this than Mr. Arka Mookerjee himself, coming from Mumbai, partner of JSA Advocates and Solicitors. Thank you, sir, for your time today. I would like to ask our past president, CA Vasudev Agarwal ji, to please come forward and present Uttariya to our speaker. Next, I would like to ask our past president, CA Jitendra Lohia ji, to please come and present our coffee table book to our speaker, the man who was behind the coffee table book himself. Next, I would like to ask CA Manish Raj Jandaria ji, our committee member, to come and present a memento to our speaker. Mr. Arka Mookerjee ji is an equity partner with over 18 years of experience in equity capital markets, advising on IPOs, QIPs, investment IPs, and major equity and debt transactions. A pioneer in the field, he has led several landmark deals and actively contributes to SEBI regulations, earning consistent recognition from leading legal directories. Sir, I would like to ask you to please come and take this session forward. Thank you, sir.
Hi. Now, I was saying normally it's a very daunting task for a lawyer to come into a room full of chartered accountants. But since it's my home city, and thank you ACA for the opportunity. And so Sanjeev ji before me has answered, sort of taken you, across to all the, regulatory aspects of the IPO. But what I'll do is I'll try and go through the processes and steps, as well as perhaps bring in, where a CA is, also important. So this is typically the IPO process timeline. You start with normally the companies sort of look forward. They work the valuation with the merchant banker, and they decide that they want to go for public. So first step is preparing of the DRHP. Now an auditor, a stat auditor, plays a very, very crucial role in looking at what the numbers are, because at the very instance, we have to. I think Sanjeev ji mentioned the criteria, right? So the criteria in terms of financials has to be brought across by auditor. Whether it's operating profit of 3 years each, 12 crores or 15 crores, and operating profit net worth, how is calculated, that's all sort of to be done by the auditor. So, the timelines of an IPO, is actually dictated by auditor more than anybody else. So I was just discussing with my colleague Pracheto, and who is sitting here. That how do we sort of, integrate the role of auditor here? So if you see due diligence drafting, that's what a lawyer and auditor does. It's a process where the auditor draws in the numbers and the lawyer drafts the offer document. Each and every number in the offer document has to be comforted by the auditor, So normally, always the conflict in some sense, or the positioning statement that we obviously, the discussion that we have in the auditor is that how much you can comfort the number to. Because as lawyers through SEBI, the merchant banker wants that every number in the book should be comforted. Now, the ICA regulations and ICA, guidelines, the code of conduct, put some restrictions on an auditor. A stat auditor cannot sort of, can only certify and comfort numbers which are coming from the, from the balance sheet, which is your P&L balance sheet and books of accounts. Any derived number should not be and cannot be comforted by the auditor. There we come the ICA, which is the independent chartered accountant. Now that's another, very highly qualified chartered accountant who complements the work of the auditor. Because ultimately, the layman, SEBI, merchant banker, us, we can only sort of go, with the number in the book, which has been comforted by the auditor. Now, SEBI, over a period of time, wants KPIs or key performance, of a company to be circled up and comforted. Now, KPIs are a very tricky subject. We have to rely on the management key credentials. What the management is going to say. So an auditor has to work very closely with the management. To ensure that the KPIs put out there in the offer document are true and correct. Because otherwise, there is a very, very serious case of where, an investor or the SEBI can say, that you have misstated the offer document, Because numbers are we can all write English and we can all, Sanjeev sir was mentioning you have to disclose litigations, you have to disclose objects of the issue, you have to write about the promoter. All English is already fine. But what an investor community invests upon is the numbers, where a snapshot of the balance sheet of profit and loss, will tell you whether the company, always tells a story because numbers not lie. According to me, numbers always tells a story. And that story needs to be brought in the offer document by the auditor. So that, there's always a conflict or a tussle, as you can say, as to what the regulator, how the regulator wants to put on the numbers and what the auditors can do. So that is what where we lawyers come in. We, act as an umpire in that sense, to ensure that the audit requirements, ICA guidelines and the code of conduct is being met by the auditors. At the same time, the regulatory aspects of the offer document are covered and the investors are satisfied that they are investing into a company based on numbers which tells a story that they like in that sense. Now, DRHP, RHP and closing. These are broadly, you can say, are the three main aspects of a IPO process. The role of the auditor is crucial in each and every stage, Probably, a banker's role, a marketing banker's role comes in when the DRHP is filed, when you go on the road show. But from the day one, an auditor drives the timelines. I often tell my banker friends, I don't know whether there are any merchant bankers in this room or not, that you can drop any timeline that you want. But the guy, who holds the pen on the timeline is the auditor. Because until he gives comfort, unless he gives you the restated financials, nobody can move anything, All your disclosures, risk factors, the key parameters comes only from the auditor's playbook, And a document can only be filed at least 3 to 4 weeks after the after the restated statements are being supplied by the auditor, And also, at every stage, at DRHP, RHP, closing, an auditor needs to give something called a comfort letter, where the letter will state that he has circled up. Literally through a ink pen or through a modern gadgets, they have circled up each and every financial number of the book and given a comfort that whether it's A level comfort, B level comfort or C level comfort. Normally, an A level comfort is where it comes absolutely directly from the profit and loss balance sheet or the statement of cash flow. Your B level comfort is where it's a derived number, where it's not directly a line item in terms of the profit loss, but it is a derived number which is done by scientific approaches and scientific methods. The C method is the most difficult for an auditor to comfort because it comes from management discussions, where it comes from local MISs, discussion with the management and certain procedures that the auditors will run. Now, often it's a dilemma with the auditor and the lawyer because sometimes the issuer always does not come with clean hands. Sometimes they would want the audit procedures to be limited. Whether it's a full audit, whether it's an examination sort of certified or it be audit standard. That standard is always a matter of debate from that perspective. Then the last position of the comfort letter comes something that you give for the broken period. For example, a document is filed on March 15th. from March 1 to 15th, the auditor will, have very limited access to MISs. Now, normally, in India, very few companies have a monthly regulated scientific MIS for all operation categories. So there the auditors comes up with a challenge to say, that how do we sort of certify that broken period numbers? Because ultimately, the 15 period can also, your P&L can, there could be a strike in the factory where your P&L can just be wiped out because there's a stoppage of work for the next 20 days. So those things are done on inquiry based. And that inquiry based is something that we always deliberate with auditors to see what best we can bring out. I think difference between 6.1 and 6.2 Sanjeev ji really stated in terms of technicals. Now, what is the real difference in mind of SEBI? If you're going with a 6.2 company, which means the company is not profit making or doesn't have the net worth, that SEBI would require. So that company becomes very risky for the retail to invest in. Therefore, SEBI has mandatorily made a provision that in those cases, 75% of anchor investors, which is your HDFC banks, all your mutual funds, and all your sort of sophisticated investors will come in. But now, my question to that also has always been ultimately in today's India, the mutual funds investment is through our SIPs, ultimately the retail sort of puts in the SIP money in terms of the these fund houses, and ultimately these goes into the public market. So although in SEBI's eyes 6.2 is more risky, therefore retail participants should be limited, and 6.1 is more basically palatable to investor because it has got profit. I don't really agree to that. Theory full-fledged, because today's market money is fungible. Because ultimately retail money is something that is which is having its play in the market. So even for a 6.2 company, the responsibility for auditors and lawyers don't change. Today you see a lot of tech companies which are not profit making come in the market. Now, while they have a philosophy, while they have a growth story, while they have a projection, that's all fine. But we as professionals have to ensure that as a lawyer, their corporate governance are absolutely safe, and their financials that they're projecting, they can't project, but at least the financial performances that they're saying in the offer document should be absolutely perfect. For example, if it is adjusted EBITDA, in terms of because the EBITDA is not showing the desired number, therefore people go for adjusted EBITDA. Now, what is the adjustment? That has to be properly explained by the auditor. It's very technical, but if you do not give the proper definition of the adjustment in the book certified by the auditor, then that would really sort of make the story very different. Now, offer for sale is something that you see in today's day and age very clearly because a lot of private equity investors, because IPO is not only about helping the company get capex or maybe acquisition or maybe GCP. A very important aspect of an IPO is to get the entry level investor exit, because that is how the market will work. If the private equity who has come in 10 years back, 20 years back can get an exit in a right IRR, that is what will sort of keep the momentum of the IPO market going. So these are certain conditions for the OFS. You have to hold it for 12 years. You have to have various authorizations, and selling shareholders should support. They should have to share the cost of the IPO also. Because because they're also an equal participant. In the IPO. So normally. There also we face a challenge. Whether we have whether we have to have an independent lawyer, independent auditor, for the selling shareholders to come in or not. That also is a matter of technical point, but we won't go into that detailing now. So there are few activities that you see while company goes to an IPO. One is conversion of public to private to public company. That's the main aspect. You have to increase your authorized share capital. You have to amend your AON, your charter documents, which is a memorandum and articles, to ensure that that your A converted from private to public, and B that your investor rights are all dropped away. And then you determine your KMP and SMP, because the IPO is a once a time lifetime. Once only a very important milestone in the life of a company. So you have to appoint your CEOs, CFOs, KMPs, etc. Right before you file the DRHP. Then of course, ESOPs are, a very important way you can sort of reward your employees. So ESOPs is something that needs to be SEBI compliant because, a lot of private companies, will have ESOPs which are not compliant. But SEBI wants to ensure that there is no, trading on the ESOPs. So they would want to make it absolutely where the grant and the vesting period, definitely is as per the SEBI guidelines. Capital structure. See, the regulator looks at 6-7 very important things in the offer document. One could be a capital structure. Second would be objects of the issue. Third and most important is the financials of the company. Fourth would be a corporate governance. And fifth will be certain, disputes and litigations. Now, these and the regulator would want to ensure that at least these 5 topics are absolutely sacrosanct before we give approval to the company. Otherwise, it's going to be a very difficult journey for the issuer company. So a cap table has to be looked at from the inception. Where you see how the promoter's cap table has been built, the fact that you have not allotted to more than 1,000 shareholders in one financial year, that's the biggest problem, because a lot of traditional companies have done that because they have pooled in money from family and friends very early on in the career, early on in the lifetime of the company. And they have given shares to family and friends which are more than 1,000 in a year. So the auditor and lawyer will have to find and diligence that why it was given, and the fact that it was no badla trading or there was no shell company trading. Those aspects are very important, because now circular trading is not looked at very well by the regulator. Normally we see a lot of capital structure built on circular trading, not always to violate the law, because that is the way they started the business, is to have the initial capex through friends and families. Now there are solutions around it, but the main important aspect is that an auditor and a lawyer will have to sit together in a room and find out that circular trading and then find solutions to it. I think offer for sale we have covered. Now dealing with existing investors. Now we see a lot of this new age companies, tech companies, trying to give exit to the shareholder who has invested in the early stage. Now SEBI has made it absolutely very clear that these investors will enjoy no special right post listing, because they should be in the same footing as you and me, who are retail or sort of money paying investors, who are going to invest into the IPO. So SEBI insists that before a company goes for an IPO, it's all its special rights except maybe for right to nomination of the board goes away at the DRHP stage itself. Of course, there are certain corporate governance which need to be taken care of, so we might sort of push it up to the DRHP stage, just before listing. But normally, all rights will have to be dropped away. So this is what we spoke about. We have to modify the chartered account, the articles of association to ensure that the document is absolutely clear. And the fact that somehow, SEBI is, of late have recognized that only the director nomination right. For example, an investor can only have the right to nominate a director on the board, but that to post listing. Pre-IPO transfers are not that much of auditors. It's more of a commercial point of view, where you sort of perhaps can give a little bit of a discount to the IPO price, not too much. They are not treated as anchors, but a pre-IPO goes a long way in getting investor confidence up when the company goes for the real sort of retail allotment. Now, see, identification of, at least I've been practicing for 21 years. There are a lot of you who have been practicing for more. But the unfortunate part of it is that we have not been able to yet tell our clients who is the promoter, because of various nuances of our, Indian cultural system. Indian family way of doing business is to have a lot of family involvement, have a lot of promoter group, brothers. Sometimes they start businesses, then going forward, they don't talk to each other. Those, sort of create a little bit of, sort of complications in our Indian system. Then private equities, they would be, could be investing into, other companies. So now, so I'm particularly part of the NSE committee, which is trying to identify who is going to be a promoter. So while you have got a straightforward definition of control, I mean that whoever controls the issuer by way of board or way of shareholding rights will be the promoter. Now, SEBI and NSE does not want to stop at that. They're saying that if a promoter, for example, is not in directly control of the management of the company, on a regular basis, but has 10% or more shareholding in the company, which is my next slide. Yeah, which is this. For example, a promoter has 10%, in a company, and he also has the right to nominate his relatives on the board of the company. Then he's a promoter. Because what he cannot do indirectly, what he cannot do directly, cannot do indirectly also. So the whole aspect is to cover and capture the direct and the indirect aspect of it. Promoter group, Sanjeev sir explained, but it's a classic. It's a three-tier structure. One goes for corporate promoter, where it's a slightly simpler, where you go 20%. Two levels down. But the complications come when it's an individual promoter, for that matter, where an individual, his immediate relative, which is your spouse and brother, sister of both sides, are known to be as promoter group. Now, 20% or more, in aggregate or an individual, where these where these relatives hold shares, that becomes a promoter group. Now, the challenge with that is, it's also very important eligibility criteria that we have to tell SEBI. That a particular promoter group is not barred from accessing the capital markets, or is not a fugitive economic offender. If either of the promoter group is this, then the company cannot go for an IPO. Now, if you go 20% two level down, so sometimes even the relative will not know. He may have invested, through his HUFs or through his, being a cutter of the company, but he really has got no control over the company to get that information out. So normally there are so many IPOs I've seen being stuck, where you have to go back to SEBI to get an exemption to say that while in terms of definition we follow the promoter group, but in reality we have got no control, or we have got no access to that information. To get a the definition of promoter group and to make sure the company goes on IPO. So this is a problem that we always fight with the regulator, to say that at least you stop to a reasonable level. Don't go two level down, because that company is not known to us in that sense. And sometimes, for example, I have filed an offer document, would not go into names, by a very prominent investor, where we completely missed one line of promoter group sort of vertical, because there was no access, to that particular group, because his wife held that percentage. I can run through quickly on this, but I would. This is exactly the slide which is important for all the auditors in the room. So I've already spoken about audited, registered financial information that you need to give. The other one is the pro forma financials. For example, if a company were to acquire another company after the balance sheet date, then SEBI would require you to give a pro forma financials. This is the only place where you can give projections. Whether voluntarily or to by way of regulations. Where you guys know how the pro forma sort of structure works. But this is very important to show that as if the acquired company were acquired during the balance sheet date, how would the P&L statement look? What would be the risks be? What would be the liabilities statement look like? So this is as if the company were acquired as of the balance sheet date. That's the projected financials that they give. A comfort letter circle-ups I've already spoken about. These are important procedures an auditor needs to carry about. On a whole, the way I look at it, that CA has two statements. One is on a strategic side, where you look at, in terms of building the cap structure, when to do a bonus, when to do a sort of split, and also to do an auditor point of view. I would stop here. I would sort of, because I would want to make it interactive, we can go on, and I can use legal jargons. But it's best that in a simple language, if you, if I can explain any questions that you have.
before we move to the house for the questions, I have a question of my own.
Sure.
From a regulatory standpoint, what are the top 3 red flags that most often like delay or derail an IPO?
See, one is the audit. The audit typically takes a lot of time. However, there's always, as I said, there's always a conception by the management that, audit can be done quickly. And that creates a little bit of heartburn in that sense. The second is, I would think in today's journey, is the promoter and the promoter group identification, because the complications of an Indian family system, even in my family, we do not know how many relatives are there and where they've invested. That becomes a very difficult position to be in, because you cannot say no to the regulator. And then you also cannot, from the public source of information, if you print anything of that company in your offer document, then that's a misrepresentation, because he will say, where is my consent? So that becomes important. But the third would be corporate governance, I would think. Corporate governance in India is still a little bit of challenge, in that sense, where independent directors are not truly independent. Sometimes they act on the interest of the board, but independent directors should also understand that they are for the shareholders and not really for the promoter board in that sense.
Okay, thank you. Is there any question? Yes, Jawarji.
What layer of 20% ceiling that you have given, the 20% ceiling that you have given with regard to promoters, to what layer should I go? The first layer, second layer? When one company, I'm holding 20% share.
So it's two levels.
That company is holding in the 20% share in that company. So to what layer should I go and, what is the SEBI guidelines for that?
So it's always 2 level down. Like for example, if the spouse or the brother, sister of the promoter and the spouse, if they hold 20% individually or 20% in the aggregate, and if that company holds 20% downstairs also, that is the problem.
Yeah.
I can tell about my shareholding into the 20%. I can force my wife or my brother to disclose that 20% into that company. But when that company goes 20% down, that becomes a little bit of very challenging situation. And that is where a lot of companies falter into.
The question is disclosure.
Question is disclosure.
To what extent disclosure has to be made?
Exactly. And so not only disclosure, I completely agree with you, sir. And not only disclosure, you have to give a confirmation that they have not been barred by SEBI in any other securities matter, or they're not a fugitive economic offender in terms of RBI guidelines. So how do I give the confirmation? Because I do not control their board of management. This is an ongoing battle and ongoing sort of, in each and every committee of the regulator, we have been pushing to ban this second level at least.
Sir, good evening. Regarding this litigation part, you said that the promoter should not be under the litigation or so. It means you mean to say the promoter group, the whole, it comes under only the man promoter, or it comes under the whole group?
Just to clarify myself, the promoter can be under litigation. So being under litigation is not an issue. He should not be barred by SEBI to access capital markets. Under any other, for example, a promoter is a director of another listed company, where there's an order on that listed company. That there has been some insider trading disputes have been done, and because of that, by the virtue of him being director of that, that listed company, he's being barred. Then his company cannot go for an IPO.
Not the other part of the litigation, not in other.
No. Other part is fine.
Ongoing in his personal capacity, and not in the capacity of a director or member of a company, still then would there be a restriction?
Yes, there will be a restriction.
So the litigation either is on the SEBI part or in the personal capacity, then there is a prohibition.
Absolutely.
Yeah, one question last. Yeah. So in your experience, while this IPO process is ongoing, say before the stage of DRHP, what are the most prominent legal issues which you have come across? What are the most prominent, maybe top 3?
See, top 3, first I would say capital structure.
Okay.
Because see, every year, everywhere, every front SEBI says 3 years is fine. I'm litigation to give 3 years. Objects, these are limited this thing. But cap structure is from day zero, And that too, for example, a company with a history of 30, 40, 50 years, then you have to go back to 50 years minus 1, 50th day minus 1 to understand the cap structure.
Oh.
That becomes difficulty. The secondly, obviously, the litigation, because in India, there is no central court or registry where in the US or something, you can just type in the name of the details of the individual, and you can get the case exists in in each and every court or not. In India, except for Supreme Court and maybe certain high courts, there is no record that a guy sitting, in me in Bombay can find about a company in Calcutta. It's not possible. The third, I would say, is object diligence. Because in objects, for example, I think Sanjeev sir was mentioning that working capital is a bad investment. Not necessarily in that sense. Now, why it has become a bad name is that people have not been able to justify why working capital is required. Because if you can justify that, by your 3 years of experience, that in terms of projections, I believe my working capital in terms of number of days and number of cycle is so and so. And an ICA, a reputed ICA like yourself, would justify and would circle up and the board would stand behind it. And working capital is fine. But most importantly, people do not know the cycle of investment in terms of the board money. That becomes a problem.
Thank you very much.
Thank you. With this, we'll end the question and answer session. I'd like to thank Mr.Arka Mookerjee for being with us and for that insightful presentation. The perspective shared today, I think, provided a lot of clarity to us in this nuanced process. Thank you so much.